Well, good afternoon, all, and thank you very much for taking time out and joining us this afternoon. As we're all aware, it's been a very extraordinary 18 months or so, and when you go through our results, you'll see that particularly affected our performance in the first half. We can all remember the fall in the equity markets, and commodity prices came off as well. And then we had a complete turnaround in the second half. Equity markets have picked up, and commodity prices in particular, which has flowed through to the Soul Pattinson result. Very big jump in coal prices and copper prices, which we're involved in. Brickworks had a very good result again. Building products were steady, and the property result was an excellent one. So before I go on, I'd just like to introduce Todd Barlow, who's the MD from Soul Pattinson, and David Grimman, who's a financial officer from Soul Pattinson. They will give you a presentation when Lindsay's finished. Lindsay's the MD of Brickworks, and Robert Bakewell's the CFO of Brickworks. On that note, Lindsay, I'll hand over to you for your presentation.
Thank you, Chairman, and good afternoon, ladies and gentlemen, and welcome to the Brickworks Analyst briefing for the year ended 31st July 21. Today I'll start by providing you an interview of our results for the year, including a review of the divisional performance, and then we'll discuss the outlook for Brickworks. Robert Bakewell will then cover through the financial side of things, and then we'll take questions, but most probably at the conclusion of Todd's presentation, as we've done previously. Just giving a high-level overview, well, it gives me great pleasure to deliver another strong result, underlying profit of $285 million. It was a record, up 95% on last year. The property trust was, of course, the standout. A very strong demand for our prime industrial land and a significant increase in the value of our portfolio. Performance across the building products was mixed. The Australian operations were largely unaffected by COVID. I mean, when I say largely unaffected, there's been numerous interruptions, and I'll get into those. And they delivered higher earnings. Our North American operations were disrupted to a greater extent and a greater variability, being more states and precincts that we had to work in, and they were knocked around quite significantly at different times. In addition to that, Washington H. Soul Pattinson delivered a great result, and our 39% holding in Washington H. Soul Pattinson increased by $1.2 billion. And a further $289 million since the end of the year, so a phenomenal return there. Those headline numbers, revenue was $890 million, down 6%. There was no property sales this year. There was some property sales last year, and there was some negative exchange rate movements as far as the North American operations were concerned. EBITDA from continuing operations was a staggering $453 million, up 61%, as I said, driven by the increased earnings from property. The underlying profit of $285 million translates into earnings per share of 189 cents, and but the statutory profit was down to $239 million, down 20% on last year, and that was because there was a large one-off profit in the Washington H. Soul Pattinson result last year. Directors are very proud to be able once again to increase the dividend both at the interim and final. The final increased to 40 cents, bringing the total dividend for the year to 61 cents. The record date will be the 3rd of November, and the payment will be on the 24th of November. We're very pleased with our graph there of the dividend performance, and it's been 45 years since the dividend was last reduced. It has either been steady or increasing, and you can see it's increased every one of the last 7 or 8 years there. Looking at value creation, and this is sometimes I think overlooked, over the long term, Brickworks has created enormous value for its shareholders. We've got a compound return of 13% per annum over 53 years. That means that $1,000 invested in 1968 would be worth $630,000 today. And of course, 1968 is the year that Brickworks and Washington H. Soul Pattinson first started their ownership of each other. Performance over any of those periods has outperformed the index, whether it be 1, 3, 5, 10, 15 or 20 years. Looking at how that that portfolio performed as far as asset creation. Washington H. Patterson's current market value $3.4 billion. 50% value of the property trust is now $911 million. The NTA of the building products in Australia, $831 million. Building products North America, $205 million. That's a total of $4.8 billion is asset backing, and the net debt of $519. So if you look at that on a per share basis, the net assets per share have increased by 149% over the last 10 years, from less than $13 to almost $32 today. And it's also worth noting that the building products has a significant amount of land in it at the original purchase price. And obviously today's value is much higher than that. Turning to safety, I'm pleased to announce that we've made steady progress on improving our safety. In the Australian operations, we just had one lost time injury during the year, which turns into 0.4 lost time injuries per million hours worked, which is a fabulous result and a repeat of the prior year. That has happened, and we've brought that about by a sustained effort over that time through disciplined implementation of safety management systems and procedures, together more recently with behavioural leadership and safety training, and that's helped us get the last little bit, just the accidents that last a little bit with it, changing the behavioural areas. To date, we haven't been able to replicate that in the US, but we are applying all the same measures that we've done here to achieve that, but we did suffer 10 lost time injuries. Part of the issue we had in the US was a very high turnover of staff, difficulty getting staff, and of course if they turn over quickly you don't get a chance to train them, let alone change their behavioural actions. The other important issue that many shareholders are asking us on an increasing basis is about sustainability. I'd have to say to you that nothing is more sustainable than clay bricks. We try and make beautiful products that last forever, stand the test of time. There's very few products on the market that can claim that. We make our bricks from clay and shale, which is abundant, although we're using an increasing amount of recycled material. Just at the moment, we're in discussions to take the spoil from the Cross River Rail in Brisbane and one of the tunnels to go to the new airport in Sydney. Obviously, we take that material, it would have otherwise been put to landfill. It means it gives us years and years and years of material to make our bricks, which is recycled. So we've issued a Build for Living strategy, which states 15 clear, measurable targets that we'll be working on going forward. But we are very pleased that we've reduced our carbon emissions by 40% since 2006, and we continue to invest in modern, fuel-efficient production processes. And we're also very pleased that we have the only fully certified carbon neutral brick range, and we've expanded that in the last year. I'll be talking about each of the divisions in detail, so I won't go through it anymore here. And I'll look first at the investment results. I won't say too much because Todd will be coming on shortly, but the Soul Patterson's delivered $97 million for the year, up 91%, with the high, as the chairman mentioned, higher contributions from New Hope and Round Oak Minerals. Brickworks received $58 million in dividends, up 3% on the prior year. And I mentioned the shareholding. I won't cover this, but Todd will, but a fabulous effort, outstanding effort that Soul's has achieved, up 13.4% for the last 20 years. Excellent, and amazing 70% lift in the last 12 months. I won't go into the merger because Todd will cover that off, although I will mention one thing, or two points. First of all is that Brickworks shareholding in Washington H. Patterson will drop to 26% because of the merger, and there will be a one-off non-cash profit that Brickworks will receive, somewhere between $375 and $425 million, because it's a deemed what's the word?
Disposal.
Deemed disposal. Yeah. It's a non-cash accounting transaction. I'll move into property, which I think most of you will find a great interest. A fabulous result. EBIT of $253 million. All property trust assets were revalued under our guidelines if the cap rate moves by more than 25 points. The revaluation profit was $149 million. And that's because there's very, very strong demand. People looking to invest their money, and they see this as good, stable returns, and it keeps driving around the return that they're prepared to accept. And of course, our industrial sheds are in excellent locations and are all, of course, A-class building. The property trust income increased by 3% to $31 million. Development profits were $24 million on the completed facilities during the period. Property sales, there was a retained earning from a previous period when we put Oakdale West. We couldn't claim it until such time as we had leases on the properties there, and that released a further $52 million of previously undeclared profits. Looking at the property trust asset value, the total trust is worth in excess of $2 billion. And in addition to that, we hold $686 million of land and infrastructure that is under current development or is developed. So this is mainly in Oakdale East and Oakdale West. Including the developed land, the total value of assets held within the property trust was $2.7 billion at the end of the year. Borrowings were $845 million, which, if you follow the calculation, means that Brickworks' half share is $911 million. It increased by $184 million during the year. And it's interesting when you look at that graph, you'll see back in financial year 12, that's all the trust was worth. And here we are now, a few years later, increasing by that amount in a single year. Gearing of the trust was very low, very conservative, at 32%. So since inception, the asset values of the trust have increased by 18% per year compound, which has been an excellent return for shareholders. We currently receive about $89 million in gross income for the trust. We have a weighted average lease expiry of 4.9 years and an average cap rate of 4.2%. We have 708,000 square metres that is currently being leased. We have 284,000 metres of area that is currently under construction, and that includes Amazon, Coles, Woolworths, and so on, all frontline companies, large corporations that if they were never unable to pay their rent, we'd have greater troubles than that. So we're very confident that they will be able to continue meeting their obligations. But in addition to that, we have 227,000 square metres of land that is addition to be developed. So when that 284,000 metres comes through, that will increase our gross income by $51 million per annum, and the value of the leased assets will increase it by $1.2 billion at a cap rate of 4.2%. Looking at some of those properties to give you a bit of an idea, this is Oakdale South, which is just the remnants of that. There's 25,000 metres under development there. This is called Site 1C. You can see that we've got a building there for Amber Tiles and Usen. We'll take that facility out. Those assets are due to be completed during the first quarter of financial year 23. Going to Rochedale, we have 3 pre-commitments up there, and if we'll build that estate out. There's 30,200 metres to be built out. It's a 10,600 square metre facility for Woolworths, a 16,800 square metre facility for CHEP, and a 2,800 square metre facility for Franklin. That is expected to be completed during financial year 22. Now looking at the big one, you can see here Amazon in the foreground and Coles in the rear. As I've told many of you before, the ground area for Amazon is 53,500 square metres, but it's 4 stories high, so the total floor area is 190,000 square metres. Practical completion is obviously running behind with the lockdown and the reduced number of tradesmen allowed on site, but if you come from interstate, you may not have heard that from Monday there are no restrictions on the number of people that can work, and so Amazon will go back to being built around the clock 7 days a week. So we're hopeful that it will be completed this side of Christmas this year, and it'll be handed over in stages. The Coles one is 66,000 metres. It commenced in January. It's expected it'll take about 18 months to build. On completion, the Oakdale West estate, it will include another building for Woolworths of 35,500 one there on the right for Woolworths, 11,000 square metre warehouse for Xylem. There's a couple there you can see undisclosed where we've got to keep them confidential. So when those ones which are leased are built out, that will be 200,000 square metres, and it's 58% of the area of Oakdale West. So there's still 179,000 square metres of area to be pre-leased. Now moving to Oakdale East. Just to the left there, you can see a little bit of the Austral Bricks Plant 3, and this is the surplus land around that plant. 10 hectares was sold into trust in 2020, and that allowed us to build that new masonry factory, which is PC'd a few months ago. And we've got a warehouse and office at the front of that. You can see Brickworks showroom in the retail area. When this reached practical completion in July, and that was the completion of the first stage of Oakdale East, and the other properties have since, on the right there, have since been pre-leased or leased. Looking for future land, we've got significant parcels of land still to go in. Well, the first of all, of course, is the balance of Oakdale East. We're building a new Plant 2, and once it's hopefully commissioned about the first quarter of next financial year, we'll be able to decommission Plant 3. Plant 3 has been a fabulous plant for us, one of our baseload plants, but it is 45 years old, and we'll be able to take it out of service, and that will release another 75 hectares of land, and we're in discussion with some parties to put some very large buildings on that as well. On the slide on the right, you can see that in Craigieburn, Victoria, we've got 332 hectares of land there. It's all south of the Woolert factory, and subject to approvals, it's mixed use or industrial and possibly residential will go into that area. And more broadly, we continue to explore what other parcels of land that we can bring on and develop over time. Turning to Building Products Australia, this is a Stokes Avenue project shown on screen. It's designed by Smart Design Studio. The architects are very supportive of us. The interior features our barrel bricks Chillingham White. This project has been featured in publications including Bell Magazine and Architectural Australia and the Australian Financial Review. It won a number of awards, such as the Milo Dunphy Award for Sustainability at the New South Wales Architecture Awards, and also the Architeaser A+ Award in the Office Interiors category. But a beautiful job. Activity in Australia was mixed during the 12 months to June 21. Detached housing activity was very strong. Besides the pandemic, it was up 32% as far as the commencements were concerned. By contrast, multi-res and non-res were down 4% and 11% respectively. The full impact of the increased housing activity has not been felt during the year. Usually there's a 3 to 6 months lag, but this has been extended because of not only inconveniences caused because of COVID, but also because there's been a general shortage of timber across the east coast of Australia for timber frames, and increases in shortages of other materials and also trades. I think the outcome of this is a little stretch out the current upturn in construction. Sales revenue was stable at 687 million for the year. EBIT was 44 million, up 36%, and EBITDA was 97 million. Conditions gradually improved over the year, and we have a significant order bank and there's a significant pipeline, we've told from all of our builders. In the second half, the sales were much higher than the first at $28 million. Unfortunately, though, the momentum came to a halt in New South Wales, where we got locked down just 2 weeks before the end of the financial year. There was a lot of sad faces that day. And our sales dropped 80%. That 2 weeks cost us something in the order of $3 million. And of course, even after the GST was introduced and after the Olympics, our sales dropped about 50%. I don't think anybody ever seen an 80% drop in sales. And of course, then the rate of stocking is very significant. And it only took a couple of weeks before we had to start taking plant offline because we started to run out of space. Since then, and I'll talk more about it, it's recovered and up until now, in the last couple of days, we're virtually running at 100% as we were prior to lockdown. So it's taken 6 or 8 weeks to get over that. Our major investment program continues at the new Oakdale East Masonry plant, reached practical completion in July, and that's in the process of commissioning. In the last 2 days, it started to go very well. And the construction of our new Brickworks in Sydney is in the Horsley Park at Plant 2 is continuing, delayed, but is continuing. Looking at the various businesses, the Austral Bricks business in Queensland was very strong. We invested heavily in that business. And it's taken us a while to, as always, to get it running to the efficiency and the performance that we like. But in the last few years, it's been outstanding. We've continued to pick up market share. And it's now running at capacity, and its results for last year were excellent. The recovery in activity in Western Australia is starting to feed through with increased volumes, and we're starting to ramp up production in the 2 plants we have online. Concrete products improved on the prior year, despite a decline in revenue, and besides having to swap plants in New South Wales. And Bristol Roofing improved its performance as well, quite significantly. Looking at North America, trends in building activity as a result of the pandemic have been similar to what we saw in Australia. Single-family home has increased dramatically across the country, and particularly in the southern states. However, at the time, this only made up about 38 or 40% of our sales. Our primary market has been in the northeast, mid-Atlantic and Midwest regions, and I call it like institutional work, schools, hospitals, and multi-res buildings. And these markets were all down between 10 and 15%. The sales revenue was steady at $152 million during the period. The EBITDA was up 10% to US $20 million, but the EBIT was down 6%. We were significantly impacted. I won't tell you all it's like trying to call a horse race. I won't tell you all the changes that happened, but I mean, with so many states, counties, various people making different calls, it was just endless, the changes were going on. And of course, because the virus was running at all times, we had constant situations where we had to drop shifts out of various plants. In the end, I think we've had something like 600 absences, and well over 100 staff have had COVID. Fortunately, of course, we've not suffered any deaths amongst our staff, but very unfortunately, many of our staff members lost loved ones during the pandemic. There was during that period, it allowed us to accelerate our plans, and we accelerated the rationalisation of our plants and our retail outlets. We reduced from 16 plants down to 10, and it allowed us to reduce the average age of our kiln fleet from 42 years to 21 years, and it was staggering that we could achieve that way in a mere 3 years. If you had to do it by building, it would be a 10 or 20 year program. We had to transfer over 200 products from one plant to another, and that's all been achieved quite successfully. But rationalising the plants has allowed us going forward to more focus our capital, which means that we can focus on the specific plants and the specific pieces of equipment that we need to improve to get our productivity where we want it. We've already completed a major upgrade at our Hanley plant, and it's running particularly well. We've got work underway at our Sergeant Bluff in Iowa, and we've got work also underway at our Lawrenceville plant in Virginia. We opened the new design studio in Philadelphia. It was opened in May, and we had a new display centre in Des Moines open up as well. The New York studio, while it's delayed, will open in the next month, and the Baltimore design studio is under construction. Last month, we were pleased to announce the further expansion in the US with the acquisition of IBC. IBC was the largest independently owned brick distributor in the United States, with 17 showrooms and distribution yards located in Illinois and Indiana. They were our largest customer, and we were their largest supplier, so it was a bit sort of natural that we got together. But it's increased our number of stores from 10 to 27 across the United States. And the sales volume will underpin our production in those Midwestern plants. It was sort of a bit of a gap, but now we've given us got solid distribution right across the area that we are focused on. With that acquisition, we picked up 225 staff, and we now have well over 1,000 employees in the US. I'll now hand over to Robert, who will do the financials. Okay.
All right, thanks, Lindsay. As Lindsay already mentioned, our total underlying group EBITDA for the year was $453 million, which is up 61%. After depreciation and amortisation, the underlying group EBIT was up 86% to $383 million. Total borrowing costs were $19 million and tax was $79 million. This resulted in an underlying net profit after tax from continuing operations of 285 million, which is up 95% on the prior year. After including significant items, the net profit after tax from continuing operations was 240 million. That's down 24% from last year's record, but that included a large one-off via our holding in WH Soul Pattinson following the TPG Vodafone merger. Then, including a small loss on discontinued operations, statutory net profit after tax was $239 million. Just focus in a little bit more on those significant items. The key items are a $29 million cost in relation to WH Soul Pattinson's significant items and the deferred taxes on our holdings in that company. There were after-tax restructuring costs of $13 million, primarily relating to the relocation of the masonry plant in Sydney, the post-upgrade commissioning of our brick plant in Cardiff in Perth, the closure of retail outlets in the US, as we streamlined there, and the staged decommissioning of production at the York plant in Pennsylvania. COVID-related costs after tax were $3 million. This was a mix of unabsorbed fixed costs in our US plants, as well as other incremental costs across the group. We had $3 million of acquisition costs over the year, primarily in relation to the purchase of IBC, and we picked up a tax benefit of $4 million in relation to US acquisition costs incurred in prior years. Turning now to the cash flow. Total operating cash flow for the year was an inflow of $140 million. That's up from $74 million in the prior year, that prior year being adversely impacted by higher tax payments, particularly the $54 million in tax we paid when we sold some shares in Soul Patts in December 2018. Capital expenditure was $117 million. As you know, the company's midway through a significant capital investment program, including the new masonry and brick plants in Sydney, major upgrades at Hanley in Pennsylvania, and the deployment of a new ERP system across Australia and the US. The uptake of the DRP that was in place last year for last year's final dividend resulted in net dividend payments being flat over the period, despite the increase in the dividend paid per share. Now looking at just a range of other key financial indicators. An anomaly here, net tangible assets per share is down 1% to $13.88. This was mainly due to a decrease in the market value of Soul Patts listed investments, particularly with the merger of TPG with Vodafone and the change in accounting that resulted in. And then also the recognition of lease liabilities in relation to a number of significant new long-term leases. The corresponding right of use assets, which are intangible, are excluded from the NTA calculation. Shareholders' equity, on the other hand, increased by $77 million to $2.48 billion, which represents $16.41 a share. An underlying return on shareholders' equity was 12%, which is up from 6% last year. As I mentioned, operating cash flow was $140 million for the period. Net debt increased to $519 million. That resulted in a slight increase in the debt to equity gearing on the balance sheet to 21%. And our interest cover was 20 times. I'll just finish on our debt maturity profile. We currently have a total of around $878 million in committed debt facilities. These include a syndicated multi-currency facility of around $632 million, a bilateral cash advance facility of $100 million, an institutional term loan facility of longer tenor of $100 million, and a construction loan facility of $46 million, which is related to the construction of the new masonry plant, and this will convert shortly into a lease as that project is completed. As I mentioned, at July 31, our net debt was $519 million, giving us around $360 million in funding headroom based on committed debt facilities and cash on hand. And as you'll note from the information we've supplied in that slide, we maintain significant headroom on our banking covenants. And with that, I'll hand back to Lindsay to discuss the outlook.
Thank you, Robert. Brickworks is in a strong position. We have conservative debt levels and a diversified portfolio of attractive assets. We're excited about the outlook for Washington H. Salt Patterson following the recent merger of Milton Corporation, giving them greater scale and liquidity and providing new investment opportunities. As I've discussed, development activity in the property trust is continuing at an unprecedented scale, and the completion of these facilities over the next 2 years will result in a significant uplift in rental income and asset value. Building products in Australia's underlying demand across the country is strong, with a large backlog of detached house construction work in the pipeline. New South Wales has been impacted by the latest COVID outbreak. I'm pleased to report that we've basically returned to our pre-lockdown sales. So it's taken about 6 or 8 weeks to get over it and get back to full speed. And heading forward, I'd see that New South Wales will continue to strengthen, particularly as the last restrictions are removed on Monday. And of course, we've brought back online that second kiln at Plant 3, and I assume in the next week or so we'll also bring back online the punch bowl operation. In the short term, there's a significant amount of uncertainty persists, as we saw with this week, with the close down or lockdown in Melbourne. And there, similar to Australia, amazingly, our sales fell 80% in the first couple of days. Assuming that it's lifted, as has been indicated by the government at the end of 2 weeks, we'll be in a situation where things will then start to recover. It's actually given us a bit of a chance to put a bit of stock on the ground because we were very tight in Victoria. But if it goes more than 3 or 4 weeks, we'll definitely have to start the same problem down there. We can't stock our entire output for a month or more. In North America, the sales momentum has recommenced following the summer holiday period, where this year everyone did take holidays. And assuming there's no further disruptions from the pandemic, we expect that we'll see improving sales through the balance of the period. However, it is taking longer for the commercial work to come back online. In some cases, this is because the developers are concerned that they don't have all the materials and they're waiting till they stockpile all the materials before they start. And in other situations, they're concerned that the costs have risen so much that it's no longer commercial to do the project. And so they're waiting for particularly lumber prices to return to a more normal level. Having said that, we've redirected ourselves into the housing market, I mentioned before, and we've now effectively got 60% of our sales go to housing, but unfortunately we don't receive the same margin from housing as we receive from doing the commercial work. Having said that though, but the acquisition of IBC is definitely going to give us a spring in our step going forward. So I won't go to questions, we'll hand over to Todd. Now I think I've got a swap. Sorry? It'll just keep going, will it? Okay, and I will be doing the slides for you, Todd, so I'll hand over to Todd.
Great, thanks Lindsay, and good afternoon everybody, and thank you very much for your interest in our company. I'll turn to the next slide. WHSP offers a unique investment product in the Australian market. Through WHSP, an investor has the opportunity to gain exposure to a range of asset classes and industries, investment strategies that have delivered above market returns for decades, steady and growing dividends, and a management team with a strong track record of execution and active stewardship of capital. Our investment philosophy defines our strategy and competitive advantage. We invest in a diverse range of uncorrelated investments across listed equities, private equity and venture capital, property, structured credit and cash. The key advantage is our unconstrained and flexible mandate, which allows WHSP to invest in and support companies from an early stage and grow with them over time. We are disciplined and value focused and willing to invest through market cycles to deliver returns over the long term. As you'll see in this presentation, we have an excellent track record of paying consistent and growing dividends for over 20 years. We are also focused on protecting capital by investing in a portfolio of assets which generate reliable cash through the market cycles and therefore perform better in market corrections. We aim to be a trusted capital partner with attractive companies and management teams who will value our long-term, stable and supportive approach. Now looking at the results for FY21, the group regular profit for the year was $328 million, which was up 93% on the prior year. The major drivers of this result came from Brickworks, as you've just heard, generated a record underlying profit and increased its contribution to us by 95%. Round Oak increased its profit contribution by 103 million as a result of higher production and higher commodity prices. And there was a strong recovery in coal prices, which increased New Hope's profit contribution by 45%. Group statutory profit was down 71%. However, you may recall that FY20 included a large one-off non-cash gain of around $1 billion from the change in accounting treatment of our investment in TPG. The company's key performance indicators are capital growth and growth in the net cash from investments. The portfolio ended the year valued at $5.8 billion, which was up 12% for the year, and the net cash from the investments was $180 million. And while that was down 29% on the previous year, again, last year we saw an inflated figure due to a large special dividend paid by TPG prior to its merger with Vodafone. The strong cash generation from the portfolio has enabled the directors to declare another increased final dividend of 36 cents per share, fully franked. That brings total dividends for the year to 62 cents, which is 3.3% higher than the last year. Total dividends for FY21 represents 82% of the net cash that we generated from our operations. We remain the only company in the All Ordinaries Index to have increased dividends every year for the past 2 decades. As I said, the net asset value of the portfolio was $5.8 billion pre-tax, which was an increase of 12%. That growth was despite our biggest investment, TPG, decreasing in value by 23% through the year. As you can see in this table, most portfolios experienced strong growth through the market recovery, with particularly strong growth in the value of Brickworks, Round Oak and financial services. The New Hope share price increased over 52% throughout the year. However, as a result of WHSP selling some shares, the value of the stake increased by 21% during the year. The equities portfolio also had a very strong year, increasing $275 million, of which only $33 million came from new investment. External borrowings were stable, despite the issuance of the convertible bond, which was primarily used to repay existing debt. And the gain in the value of the structured yield portfolio was a result of new investment of about $148 million. The TSR performance has been very strong over any period of investment. As a long-term investor, our focus is on delivering outperformance over the long term. And WHSP has outperformed the index by 4.7% per annum over the last 20 years. This outperformance has had a material impact on shareholder wealth. Over that 20-year period, an investment in WHSP appreciated over 11 times, which compares to a 4.3 multiple for an equivalent investment in the market. And the 40-year performance is even more impressive, with a compound annual growth of 14.7%. If a shareholder had invested $1,000 in 1981 and reinvested all of those dividends, the shareholding would have appreciated to around $240,000 40 years later. We've remained a very active investor. A couple of years ago, we had a slide showing the active M&A amongst our major investments over the past decade. However, it's also worth noting that we remain very active on our own portfolio. Over the last 3 years, there's been a total of $2.3 billion in investments and disposals, and $1.1 billion of that activity was in the last financial year, as we were actively investing in the market recovery and repositioning of the portfolio. While WHSP is generally fully invested, it does retain liquidity for opportunities, but it essentially means that we have to sell assets to invest in new ones. The gap over the last 3 years, where investments have exceeded divestments, has largely been funded with cheap debt. And the activity has been across the board, with an increase in allocations to private equity, structured yield and public equities. I'll now cover off on some of the key portfolio themes in the portfolio. TPG now has a year end of 31 December and recently released its half-year results. For the half year, TPG reported EBITDA of $886 million on $2.63 billion of revenue. Both of these numbers were 3% lower than the pro forma period last year. These were solid numbers given the continuing short-term headwinds from NBN migration and COVID-19. Pleasingly, we are seeing some improved trends with increasing on-net subscribers in fixed broadband, market repair in terms of ARPU growth in mobile, and synergy realisation from the merger tracking ahead of expectations. TPG is a full-service communications business with scale and a significant amount of infrastructure assets. In mobile, Vodafone is rolling out its 5G network, which by the end of this year will have excellent metro coverage and service 85% of the population. TPG has very competitive spectrum holdings, which will serve it well as take-up for 5G services increases over time. The 5G rollout will allow TPG to offer fixed wireless services to bring customers that migrated to NBN back on net. TPG already has the second largest broadband customer base in Australia with over 2.2 million subscribers and a 24% market share in NBN. And I think I mentioned at the half, for every 100,000 customers that sign up to fixed wireless 5G broadband, that would represent an additional $50 million of margin. Importantly, TPG and Vodafone provide excellent service with fewer complaints and award-winning products and customer service. There's a very large asset base, and TPG has announced a potential to look at selling its mobile towers, but the fibre optic network, international subsea cables and connections to customers are actually far more valuable assets. As an investment theme, we are very attracted to telecommunications as an essential service where demand for data is growing, and TPG in particular is very well placed. It has a network that will become increasingly valuable as we move into the Internet of Things and technologies such as driverless cars. TPG is a low-cost competitor, which we are always attracted to as it provides a margin of safety and competitive advantage. It will also continue to achieve integration wins, not just from cost synergies ramping up, but the ability to cross-sell and win market share as an integrated supplier. And the short-term impacts of COVID will reverse as borders open up and international travel resumes. I won't go into too much detail about Brickworks given Lindsay's comprehensive presentation, but we're very comfortable with our Brickworks position, given its commanding position as a supplier of building products in Australia, benefiting from strong growth in detached housing. And we're also excited about the prospects in the US, where Brickworks is building out regional scale and efficiency in markets that are currently seeing strong residential demand, and non-residential demand is expected to pick up on the back of government stimulus. As Lindsay outlined, there's very strong and rapid growth in the value of its industrial property, and there's also significant further growth from pre-committed developments as well as the future development of land. New Hope reported an underlying EBITDA of $367 million, which was 27% increase on the prior year. It really was a tale of two halves for New Hope. In the first quarter of FY21, thermal coal index pricing sunk below US $50 a tonne. And by the end of the year, prices were over US $150 a tonne. And you can see on this graph that if we just focus on New South Wales, the second half revenue was 63% higher than in the first half. I focus on New South Wales revenue for two reasons. Firstly, the Queensland operations contributed little to profit. And secondly, the Acland mine will cease production within a few months. New Hope is back before the Land Court in Queensland seeking approval for Stage 3, but it will be some time between cessation of mining at Stage 2 and commencement of Stage 3. On the next slide, we have this graph shows the average price New Hope received for product broken down by quarter in FY21. The first quarter was under $70 Australian dollars a tonne, an increase to around 120 Australian dollars a tonne in Q4. And since the end of the financial year, prices have remained strong and the index pricing is now over 240 Australian dollars a tonne. So just in August, the first month of FY22, New Hope has already produced over $100 million of EBITDA. Coal prices are currently at levels not seen since 2008. It is clear that there is still strong demand for coal, notwithstanding China's ban on Australian product. Australian producers have switched supply to other countries, and global supply is still constrained. We do not expect to see the same supply response we saw back in 2008 when large new mines were brought into production. You can see on this graph that Bengalla is very low on the global cost curve of all thermal coal mines. This not only contributes to the high margins in the current environment, it underpins the sustainability of operations into the future. We're extremely cognizant of the fact that global coal demand will need to reduce if the world is to meet its ambitions to cap global warming. Coal remains the largest source of electricity generation in the world, accounting for around 40% of global generation capacity, and its importance is even greater in Asia. Bengala has an approved mine life that ceases before 2040, and the stage 3 of New Acland would have a similar lifespan. In this graph, we've illustrated the drop in demand modelled by Wood Mackenzie in their two accelerated energy transition scenarios. The most aggressive reduction in coal would be part of the achievement of the accelerated energy transition scenario, which limits global warming to 1.5 degrees, and would see a drop in demand of coal by 30% by 2030 and a drop of over 65% by 2040. New Hope believes that its position as a responsible operator of coal mines, producing more efficient and lower emission coal, will make its operations resilient to falls in global demands of this magnitude. In a scenario like this, we would expect to see a rapid reduction in supply of higher cost, dirtier coal from the global seaborne market, and we do not expect to see meaningful new supply enter the market. Looking now at Round Oak Metals, which is a wholly owned subsidiary of WHSP. Over the last few years, as you know, we've been building out our operations across Australia, and we have assets in Queensland, Western Australia and Victoria. In FY21, we finished mining the open cut Barbara mine in Queensland, and we're exploring an underground extension. And we continue to mine the Mount Colin underground mine. Jaguar in Western Australia has a few more years left. However, the nature of the deposit there is that there tends to be ongoing opportunities for extending the mine life, and we're certainly seeing those opportunities at the moment. We've also been progressing the Stockman asset in Victoria. Stockman is a long life development asset with approximately 10 years of production. It has all of its key approvals, and we're currently fine-tuning the mine plan ahead of its development. Last year, Round Oak produced an EBITDA of $183 million as a result of increased production and efficiency at the same time as an increase in commodity prices. After the COVID-19 disruption to commodity markets, FY21 saw the price of both copper and zinc, which are the major commodities produced by Round Oak, increase by 50 and 30% respectively. We believe that copper has some structural tailwinds in supply and demand that will continue to support higher prices. Copper has traditionally been a proxy for global growth, and as we see China and the rest of the world emerge from COVID-19, we expect demand to be very strong. We also believe that copper is a key component of the transition to renewable energy and increased electrification, including the uptake of electric vehicles. On the supply front, we're seeing globally a decline in copper grades, increasing capital intensity required to mine new deposits, and declining discovery rates. When we put these things together, there is likely to be a supply gap emerging in future years. And for these reasons, WHSP is currently exploring opportunities to enhance Round Oak's ability to be a meaningful producer of metals, and we're currently considering an IPO which would enable Round Oak to attract new capital and be a platform for growth. If we look at the other investment segment of the portfolio, there's around $2.2 billion in assets spread across 7 discrete portfolios. This segment increased in value by 38% through the year and contributed profit of $129 million, which was 87% higher than the previous year. You can see in this table that there is a good balance across each of the portfolios. And obviously, once the merger with Milton takes effect, there will be a significant increase in the large cap portfolio initially, and it will be our job to increase the balance over time. The financial services portfolio includes investments in LICs, funds management, and financial advice companies. We saw a strong market recovery after COVID-19 market disruption, and that benefited not only valuations, but operating companies like Pengana and Ironbark. We believe this theme has strong fundamentals with the growth in superannuation assets under management. The pharmaceutical and health portfolio may undergo some changes in FY22. As many of you will be aware, the largest asset, API, is currently under offer from Wesfarmers, and WHSP has indicated its support for a transaction that is recommended by the API board. We remain interested in looking at new opportunities in the health, retirement and aged care sectors. The large cap portfolio is a diversified portfolio of Australian equities, generating a strong yield, and it contributed $12 million to operating cash flows in FY21. The small caps portfolio had a very active year and contributed significantly to profit and net operating cash. This portfolio is more active in short-term trades which realise cash profits, and we saw some solid gains across many of the portfolio's major positions. The private equity portfolio saw increased investment in the agricultural real assets of $60 million, And the other major assets include AMP Control, which is leveraged to the commodity cycle, as well as the growth in renewables, energy transition and infrastructure investment. And we also continue to invest in swim skills through Aquatic Achievers. Our property portfolio is relatively low as a proportion of the overall portfolio for a few reasons. We've been recently taking profits on a few assets, and we also take into consideration our look-through interest in Brickworks' substantial property portfolio. We are, however, continuing to invest in new assets, and in particular suburban industrial property, where we see strong fundamental growth. And finally, our structured yield portfolio has seen a lot of growth in FY21 with nearly $150 million of new investment. The running yield of the portfolio is 8.4% and generally includes high cash yield loans with some downside protection mechanisms in the form of security or seniority above other capital. There's a healthy mix of industries, and we're keen to continue to build out this portfolio. As for outlook, I'll talk about the impact of the Milton merger on the business. We are very excited to announce that the merger of WHSP and Milton Corporation has been approved and will complete on 5 October. This is a highly strategic transaction for WHSP and will deliver a number of key benefits. Lindsay, if you wouldn't mind just flicking over to the next slide. Firstly, an opportunity for greater portfolio diversification and additional liquidity for future investments. Secondly, the addition of the Milton portfolio will increase cash generation across the company. Thirdly, we will welcome up to 30,000 new shareholders, which will virtually double the number of shareholders and increase liquidity in our shares. Fourthly, we will see significant uplift in market capitalisation and free float, which will increase WHSP's index participation. And lastly, the Milton investment team will nicely complement WHSP's existing capabilities. Immediately, you can see that the gross value of the portfolio increases from $6.5 billion to just short of $10 billion on merger. The heavy concentration of our core investments in Brickworks, New Hope and TPG, which currently are 58% of the portfolio, will reduce to less than 40%. We'll see a large increase in the portfolio weighting to the diversified large cap portfolio. However, these assets are highly liquid and give us the opportunity to reallocate to other parts of the portfolio as we see new opportunities emerge. Milton employs an experienced and high-performing team to manage its assets with a similar philosophy to WHSP. We are delighted to welcome this team to WHSP, where the expanded team will be able to leverage investment opportunities and ideas across the larger platform. We're also pleased to announce that Brendan O'Dea will become WHSP's Chief Investment Officer. Brendan has a distinguished career across the globe, managing a range of assets and investment teams, and we are confident his skills will provide significant benefits to WHSP. Looking forward, WHSP will have significant liquidity for future investment. In a cautious and disciplined way, we will seek to reallocate up to $2 billion of Australian large cap equities into diverse assets as they become available. Our gearing levels will be significantly reduced, enabling further gearing to be introduced at the right time and for the right assets. As I outlined earlier, we have a strong deal flow as evidenced by the $1.1 billion of activity in the past year. As we expand our investment horizons and investment team, we think that deal flow will increase. We're opportunistic in our approach, but we're also looking at a few key themes. We're interested in broad investment themes such as health and ageing, energy transition, agriculture and real assets, financial services and education. And we're interested in the way that technology can play a part in dislocating existing businesses in these industries. We're also very keen to establish platforms that allow us to build upon. This is an approach that has worked well for us in the past, and we believe we have some very suitable assets in the current portfolio that we can build around. Thank you very much for your time, and I'll now hand back to the Chairman for questions.
Thank you, Todd. I'm not sure if Rob's going to come in for questions, or I'll just might go to Lisa. I think the questions have been coming in by email, and we'll get across to those.
Thanks, Lindsay. This is for Brickworks. Could you please update on industrial gas prices, including what AEMO assets are potential future supply issues in Victoria?
Yes, well, we've had a 5-year contract with Santos to supply gas on the East Coast. That was at better prices than we were previously paying. That contract still has another 4 years to run. And we've got indications that they and some other parties will be prepared to provide gas after that point of time. We're also looking at the production of synthetic natural gas as a way in which that we can make our products more sustainable overall. So at this point of time, we're okay. There was a lot of volatility in the market, and we used our flexible contract to have trading opportunities where we were both buying and selling gas at different times, and that was quite a profitable exercise for us, and something we couldn't have done before we were in the wholesale market. Next question, please.
From the 2-week or longer shutdown of Victorian construction plus continuing CFMEU unrest, do Brickworks expect problems such as build-up of inventory or an unrecoverable loss in sales?
Yeah, well, as I mentioned, sales fell off 80%. The same experience in Victoria as what we had in New South Wales. Obviously, we're now stocking at the rate of in excess of 3 million bricks a week. We have adequate space to go for about another 2 to 3 weeks before we'd have to consider starting to ramp down production. But in actual fact, it's very it's going to be profitable for us because we're able to build our stock up in Victoria, which means we can supply more product from Victoria and not have to bring it in from interstate, whereas we're always a bit shorter supply in Victoria. I think once it gets going, I don't think the jobs will be lost, they'll just be deferred. My biggest concern in amongst all that is that a lot of builders, their costs will have increased because of the delay, and that they might be building houses at a loss. And so therefore I think, in next year we're going to keep an eye out for potentially some builders getting into financial difficulty.
Okay, next question. 73% of Building Products Australia's sales revenue is from New South Wales and Victoria, above their combined population share of just under 59%. Does this remain okay, given that many have left Victoria for good and more will emigrate overseas and to Queensland as the borders reopen?
Look, this is a really interesting question, a good question, because it shows a fair amount of insight into what's going on. Yes, in the longer term, the lack of immigration is going to be a concern, and it's unlikely that immigration will immediately return and try and recover the lost 500,000 people that haven't immigrated. It's more likely to be quite slowly recover, so the loss of people in Australia that we would have otherwise had could blow out to more like, say, 750,000. In Victoria, they have generally gained from immigration, and their population has been increasing because they haven't been losing the people to the same extent New South Wales. New South Wales has always lost more people to other states than any other area, and this, I suppose, held back the growth of New South Wales. But listen, having said that, we're in a very good position in Victoria. When we replaced the 3 plants in the last sort of 12 to 14 years that we had down there, we didn't put back the original capacity, which was about 230 million bricks per annum. We only put about 170 million bricks in. So we have been running short of capacity ever since, and we've been pulling in product from South Australia, Tasmania, New South Wales and Queensland to maintain supply down there. So what that will mean, if there is a bit of a slowdown in housing in Victoria, is that the demand will more equally match our production. So from that point of view, I don't see it's a particular concern. And of course, where the people move, they're going to need a house. So we'll be in a position to pick them up at the other end. If they move to Queensland, we'll pick them up there. Yeah.
Okay. With the important property trust, when you refer to medium-term possible development of Craigieburns 332 hectares, and separately similar for the remaining 75 hectares at Oakdale East, do you mean 5 to 10 years for each?
Look, we've traditionally developed these areas at about 30 to 50,000 lettable square metres per annum. And as I mentioned, we're running at currently about 270 or 280,000 square metres. So it is absolutely extraordinary. I would sort of tend to think that it's got to steady up a little bit particularly once we get out of the COVID and maybe online sales slow down a little bit. So I think that will come back a bit, and that will give us more time. I think and we're also, by the way, we're still bringing on properties, and this will be ongoing as we decommission factories and make the land available. So that will continue. Clearly, we've developed a lot of land. If you go down the coast in Queensland, we've actually got enough to develop out the land we've got. We're most probably at least 5 years in New South Wales, and maybe longer. And of course, we haven't started the one in Craigieburn. So Craigieburn, 330 hectares is enormous. And of course, to the north of there, we have the Wollert facility and a significant amount of land around that. I would think that overall that the Victorian development is something that could go on more like 10 or 15 years. Yeah, a bit of difference timing there. So Queensland, we're almost up against the wall, if you like, up against the factory. New South Wales, 5 to 10 years. Victoria, 10 to 15 years.
Okay. It's a question from Peter Stain from Macquarie. Could you give us a sense of the process and indicative timelines of the realisation of your on-balance sheet property at Craigieburn and Oakdale East?
Well, I think I just covered that.
Covered that one? Yeah. Okay. David Williamson, what do you believe is the real value of Building Products Australia, including all land at current market?
Well, look, I think we've indicated in there that the land is held in the books at the original purchase price, and clearly we've seen extraordinary growth in the value of land. So the value of land behind the building products is significant. It's something that we're looking at. The valuation given to building products doesn't seem to take that into account. Or if you look at Brickworks overall, you'll say, why is Brickworks a little bit undervalued? We've sort of indicated here we think a better price for Brickworks is more about over $30. And you know where that is, and that would be one area that we're looking at, that maybe it's in that hiding under that rock.
There's a question from Daniel Kang at CLSA. Congratulations on a record result. With the carbon neutral brick range, are you seeing or do you expect a premium to emerge for this range?
Yes, particularly architects that are trying to get the embodied energy in a building down. This is very popular and they're prepared to pay for them. I would say over time we'll gradually expand that, and partly while I was talking about that synthetic natural gas, if we can get a significant supply of synthetic natural gas, we'll be able to offer all of our products as carbon neutral. And also I've got to say, I don't think some of the questions and some of the analysis we've had on our product range that I've seen in the last 6 to 9 months, I don't think it's fully understood. Investors appear to be looking at the first level, what's the embodied energy. They're not looking at the second level, what is the energy consumption of this building, you know, by using the various products. And clearly that is a much higher number and far more significant than what's the embodied energy. You know, it's a bit like looking at the cost of a car and not what the fuel efficiency is of it.
Well, then you've got the replacement cycle as well.
That's right.
Of the other products.
Yeah. As you know, we guarantee the bricks for 100 years and you know, they could easily go 1,000 years. So. Another question?
Another question from Daniel, again from CLSA. On property, can you provide some thoughts on your expectations for development profits and land sales that may fall in financial year 22 and 23?
Well, we've indicated the biggest one there. We've indicated that once we get the new plant, plant 2 operational, that we'll decommission plant 3, and there's potentially in stages up to 70 hectares of land on the Oakdale East site. We'll be able to go into the trust, and so this at this point in time, I think, is really going to be in the first half of next year. Yeah. But don't hold me to that because there's a lot of moving parts, and we've been delayed trying to get engineers in to get our plant built, and you know, and we've got no idea what other hurdles are going to be thrown our way over the next 12 or 18 months.
Okay. Another question from Peter at Macquarie. Inclusive of IBC, could you give us a sense of fixed variable cost split in the US and how you see operating leverage potential in the context of improving demand?
Not off the top of my head.
Good question. Yeah. There's a fair bit of integration to go before I'd like to give any kind of view on that ratio.
Yeah. It's quite an effort to integrate IBC. Yeah. And the second part of that is what was the
margin leverage. I think
I just lost it.
The complementary products that they sell at that higher margin.
Yeah. Look, I think the most important thing for the future profitability of the United States is for us to see our institutional work return. The schools, hospital, we'd always have a dozen high schools underway. They're all about $1 million bricks each. We're doing university extensions, football fields, baseball pitches,
all sorts of municipal buildings.
These things, and the New York's back, and we'll get back into that high-rise buildings, etc. But it's overall, it's not. It's very disrupted, and enormously variable. in these areas.
There's a question from Raju at CCZ, also on the US market, noting increased material costs, making a number of non-resi projects less justifiable. Do you see that risk emerge into housing as well? And what is your view on the timeline of normalisation of this lumber price challenge?
Yes, look, good question, Raju. Thank you. What my experience has been for housing, yes, there'll be some people that will have difficulty paying a higher increased cost. Some of them, of course, have fixed price contract and they'll put that burden back onto the builder, and my concern, therefore, about builders starting to build houses at a loss. But what we've historically seen is when the overall value moves up, there's a whole lot of medium density and other developments which now become viable that weren't viable before. And that has generally produced a second leg. So you get, the first leg is people start buying houses, and because there's no existing houses available, they've got to buy new. That's the first leg. Prices of existing houses go up. And then the second leg is medium density development becomes viable, and we see a second wave of work caused by that increased value. And I would have no reason to believe that we won't see that again this time. And I also believe that there's a good chance, because of the low interest rates, high employment, there's a lot of people who would like to buy a home that haven't bought a home. The historic percentage of people who have bought a home or buying a home is low, and we could see that increase. It only have to increase a couple of percent of people that are wanting to buy a home versus rent, and you'll see strong demand caused by that. So while we're seeing lower immigration, I think there's quite a few positives there that may also drive the market going forward.
Okay, question from Raju again. The Brickworks Australian housing market. It appears that housing market recovery post-Royal Commission, expats returning in 2020 and the pull forward of demand with stimulus should support a solid financial year 2022. What are your thoughts on approvals from here on in, and do you see risks of reverse migration ahead?
Yeah, well, there's always a potential for reverse migration, and we spoke earlier about the moving around, people moving around the country. I think a lot of people have reassessed their lives because of COVID, and that's why we're seeing such enormous turnover of staff in our operations, both here and in America. So people are reassessing their lives and deciding to go live somewhere else. So that's clearly going to be one of the trends. What was the first part of that question, Lisa?
Housing starts.
Yep.
Yeah, look, there's definitely a full year. We're seeing some mixed results. Many builders are reporting that their sales have continued on strongly, even though the stimulus has come to an end. So that's positive. But look, there's no doubt what we're seeing in Victoria at the moment. There's going to be, a month or so hole in the sales because of the lockdown, and people physically can't get out. So once the lockdowns lift, I think we'll see a stronger level of sales than what we're currently seeing. But I mean, this is what we've been going on now for 18 months. I mean, it's stop start. It's like trying to call a horse race. It's just changes continually all the time. So.
And a final question from Raju in regards to property. With regards to your expectation of 60% growth in gross rents within the coming 2 years or so, can I please confirm if this is all committed? Is this just tracking?
Yes, this is the 284,000 square metres of pre-committed work that we've got agreements to lease on. This is buildings we're building for customers, the Woolworths, Coles, Amazon, signed up. Yeah.
Okay. Ross Illingworth from Kingfisher Capital Partners. What is Brickworks' ability to increase trade prices for clay bricks in Australia and separately the US market to insulate against rising input costs, particularly rising energy costs?
Well, our energy prices are contracted, so we haven't faced increased energy costs here. We have now started to lay out long-term contracts in the United States at a number of our plants as well, so we're fairly well insulated there. We've put in additional price rise this year, a significant price rise, and we're not. There's a lot of volume builders that are very unhappy with us at the moment. But I mean, these shutdowns all cost money. These delays cost money, and we have to recover it as best we can. And I can assure you, many builders are having quarterly price rises to recover their costs as well. So we are getting price rises. We continue to get them, but our cost, one of the great things about our business is our main raw material, clay, we already own it all, or as I mentioned before, with receiving material from two tunnels being built, that we often get paid to take the raw material. So when you've got that tied down, our wages are generally on EBAs very low, 1.5%, 2%. So that's pretty well tied down. We've had more difficulty in the US, I must admit. Our gas is contracted. We've got in that there, we've mostly got 60% of our costs all under control. So the main thing is just to keep those prices moving forward and keeping those margins climbing. And hopefully we don't have shutdowns. Shutdowns cost money. Decommissioning plants, and like we've had to do, cost a lot of money.
What are the challenges you talk about for the WA Bricks business?
Yes, well, it's very interesting. BGC has now taken over Midland and they've branded it as Midland. They have now started to consolidate their product range and they're telling customers, so customers are seeing that they're not going to have the existing range that they had and are starting to make inquiry with us, and we're starting to win back major accounts that we'd lost during that long drawn-out battle or war that was going on in WA. Prices have started to lift, but they need to lift further. Demand has started to lift, it needs to lift further. But I think, and also, you know, we've got to have resolved what happens to BGC, because BGC itself is still for sale. I haven't had anything recently, but I assume either this side of Christmas or early in the new year, that whole organisation will be coming on the market, and we'll have to see how that plays out. So there's a few moving parts still there, but the early moves are positive for us. It's returning to a more balanced market. I think that we'll see our market share will gradually climb, assuming that we can make high quality products, give good service, you know, that we'll gradually pick up our market share, and over time we'll recover. And we're still obviously making losses in the West, but we're starting to pull them back.
Okay. Do you think there is a round of consolidation to happen in the Queensland cement market?
Well, a lot of moving parts there. Yes, and look, I wasn't mentioning it, but there is some tension in the cement market at the moment because the price of shipping, and there is a genuine concern with the supply line, whether or not there's going to be shortages, and also in regards to oxides are concerns. If anything I was concerned about, I'd be concerned about those two. We have made arrangements with some of the other competitors where we're able to get product on a tolling basis. And so we've sort of been accepted into the industry. But look, there's potential. Yes, there is potential for consolidation. I could make some suggestions, but I'm not going to make them publicly, what might happen. But I think you're just going to have to watch this space and see, because it is quite untidy. And in actual fact, we're seeing more, right across Australia, we're seeing more competitors online. There's a terminal that's been there for a while in Newcastle. There's a new terminal just come online in Port Kembla. Yep. We're seeing this starting, and I hear there's a terminal being built in Adelaide. So a lot of people like ourselves that used cement realise that they could, you know, for a commodity, get a better price by having their own terminal. And we're in a bit of an unusual period at the moment, but I'm hoping that will sort itself out in the next 6 months.
Okay, that's all for Brickworks. Thanks, Lindsay. I have a question for Todd. With the Milton merger expected to increase the group's net cash from investments, can you talk about how this may potentially impact your thinking about dividends and payout targets?
Thank you. Yeah, look, I think the merger is going to be directionally positive for dividends for a number of reasons. You know, I mean, even before the merger, we had a portfolio that we had invested in over the last few years to try and enhance the dividend income that we receive, and the benefits of some of those investments will be seen over the next few years. In addition to that, we're seeing, you know, very strong underlying results from you know, our businesses such as you know, Brickworks, New Hope, and TPG. So even on a standalone basis, we were expecting quite good cash flow growth over the coming years. But then when you overlay the merger, it's directionally positive for a couple of reasons. One is that Milton is a higher yielding portfolio than Soul, so that's accretive from day one to dividends or cash flow per share. But the other aspect that I think will be different going forward is that if you look at the payout ratio that Soul's has paid in the past, you know, for example, last year we returned 82% of the cash that we generated from our portfolio to our shareholders as dividends. And we've sort of generally been around that region of 70 to 90% in recent years. And the reason why we hold some back is to make further investments. But with the Milton transaction, we have access to significant amounts of liquidity. So the need to hold back cash to make new investments is less. So, the board certainly has the capacity to increase payout ratios as well as seeing higher net cash generation on a per share basis. And we have huge bank of franking credits to enable that to happen.
Todd. That's all for today. Someone was just asking if there's a catch-up video available, which there will be later today. So that will be up on our website. That's all. Thank you.
Thank you. Thank you, everybody. I'm not sure if the chairman wanted to make any final words. Okay. If not, all right. Well, thank you very much for your attendance today. We greatly appreciate your interest in our companies. And we look forward to the AGM, which unfortunately will also be done in the same manner. We won't see you in person, but hopefully next year we get the opportunity to catch up in person and have discussions with you and answer your questions more fully. So, but thank you very much again, and good afternoon. Thank you.
Thank you.